Okay. So, wow, I'm really such an honor and a privilege to be able to introduce my guest. He's nobody, no one, he's Jun Tarrobago. He's the head of equities of one of my favorite investment houses, no, ATRAM, ATR. People still refer to it as ATR Kim Eng, but it's ATRAM. Uh,
Uh,
I talk to him quite often. I get a lot of information from him. And although he looks young, he's been in the market for what is close to 25 years or so, right? So he's been
yes,
there
25 years.
25 years. You started what? 4 years old, parang ganun, 5 years old. No? So,
Hindi naman. But we've lived through three of the worst financial crises in history. So this is a bit timely, I guess, our conversation now. No? Yeah.
yeah, and our
Medyo
topic
napagdaan ng matindi yan.
our topic today is comparing the 2008 crisis with today's crisis. There's a lot of people are comparing it. People are saying it's the same. There's a lot of similarities, and not exactly the same. I mean, my background is economics. I mean, this is a financial 2008 is a financial crisis. This is a real economic crisis. Although we're going to talk about the similarities and how it's going to affecting the market. Should I say, spooking the market? And what better person to talk about this is one of the siguro not to make it one of the most brilliant investment managers, fund managers that I know of, si Jun Tarrobago of ATRAM. So Jun, um, again, we're doing a lot of comparison. What would you say would be, and is this reminding you of 2008? What's going on? Is this a reminder of 2008?
Yes, Randall, in terms of the volatility in the market, the wild swings in the market, this definitely reminds me of 2008. And this is definitely, we're seeing a lot of panic in the market right now. And because of that, this definitely reminds me of 2008.
So June, what were you doing in 2008? Just curious, what were you doing in 2008?
In 2008, I was fund manager for ING,
Okay.
investment management already. So we were in the thick of it already. And yeah, I mean, I've lived through that, the early 2000s crisis, the Asian financial crisis. So I guess, Randall, in terms of uh, learnings or wisdom, uh, what maybe it's important to first uh, uh, first gain perspective in terms of uh, every single, I guess, to put it very concisely, every, at least based on my 25 years of experience in the markets, every crisis is unique and different.
Mm-hmm.
And every crisis at the same time has commonalities. I mean, people react, markets react to crisis in I would think similar ways. For example, indiscriminate selling leading to panic selling, and it's a cycle. Eh. So I guess the lessons from that is to try and be as objective as possible. The market will reflect information, whatever information is in the market, and the markets during crisis reflect more of the feelings of people or the sentiment or the emotions prevailing at any particular time in the market. So I guess the lesson from all of those years being in the market is really to try and keep your head as much as possible. I mean, try and stay rational. That doesn't mean being a hero and jumping in and buying. Okay, the market's down 12% today. I need to buy. Why are you buying in the first place? And is it at a good level to buy? It's asking yourself those questions. So, and is the market fundamentally sound if you look at it 12 months forward? So, as I mentioned earlier, there's every crisis unique. There's commonalities for every crisis, and the cycle is similar. You see something brewing, and then eventually a series of events trigger indiscriminate selling, and then eventually panic selling, and then what if you look at the charts over time, you want to look if you're a serious long-term investor. If you're a short-term investor, I think what the one of the best things you can do is just stay out of the market if you're a short-term investor. But if you're a serious long-term investor, you historical data will show you that what you want to look for, assuming the long-term outlook is not broken, the economy is not broken. And I don't think the economy is broken. As a matter of fact, I think the economy is very strong. And if you look at the consumer numbers in January, that reinforces that point. But you want to look for peak panic levels. So as I said, it's stages. You have indiscriminate selling followed by panic selling, and then what you want to look for is peak panic, which is usually indicative of market bottoms, and usually after the peak panic selling, you see the markets either stabilize because exhausted, the selling is also exhausted already. You see the market stabilize and eventually recover. So I don't think we've reached peak panic levels already. I think volatility will remain in the market, and this panic selling, these are things we cannot control because this is the emotion. It reflects the emotion, the fear of people in the market, and it may not even be fear because of the economic impact. It may be fear of, oh, my neighbor was got diagnosed as as my neighbor got sick, etc., etc. And all of that is very important. But for long-term investors, it's important to keep informed and to gain as much perspective as you can. And past perspective, and current perspective tells us that there are significant, that the market, the indiscriminate selling has hammered the market down to crisis levels, and not just crisis levels. The panic selling has hammered the market to levels, to crisis levels where we had the worst financial, in terms of the worst financial crisis in financial market history.
Okay.
And this is the 2008 credit crunch.
I have a question for you. Are we seeing, have we already seen the peak of panic selling or not yet? It's not yet there.
I guess my answer is I don't know, but there are signs. I don't. You'd have to be exceptionally gifted to know when exactly the bottom. If you're trying to find the bottom where exactly that is, I'm not even trying to do that. We're just reading all the information that we have, and what we do know is that peak panic could happen within the next 4 to 8 weeks, and the signs to look out for: number one, COVID-19 daily infection rates peak. Mm-hmm. Number two, global manufacturing indices hit troughs or have bottomed out already. Number three, there is already clear-cut fiscal easing that becomes more and more evident. I think we've seen that in the US, we've seen that here as well. And of course, the fourth factor, but we can't input that, is when a vaccine is finally announced. But I don't know if that's going to happen soon. I wouldn't bet on it happening soon. I hope it's going to happen soon. But the three things: daily infection rates peak, global manufacturing indices bottom out, and third, if there is sufficient and clear-cut fiscal easing evident from the government's the powers that be. When those things are in place, and we think that's going to happen within the next 4 or within the next 8 weeks, that is most likely going to be the bottom.
That's it. And that's
when exactly, Randall, I don't know. I'm sorry.
But June, that's already beginning to happen. You know, the pronouncements of the BSP, you know, the spending of the government will be, and all these things. And a lot of these things are happening. US is starting to do it. So we're seeing bits and pieces of these things. Maybe we haven't picked the COVID. No, it's going to happen. So the question is, should you spend? Parang mag-i-effort pa ba tayo para hanapin pa talaga yung bottom, or can we take positions at this point in time?
Our strategy is to not really try to find the bottom. I mean, it's good to be aware that this could be the bottom, but our strategy is a disciplined approach in terms of being consistent and disciplined whenever there is a massive sell down in the markets when the market days when the market was down. I think 12 or 13%. We were accumulating. Not being a hero, we're maintaining cash levels, about 8 to 10%. But at the same time, we're deploying when there are those big moves in what we think are best of breed blue chips. Because in the past, the complaint was always the Philippines is expensive. I can't buy. There's no value, even if there was growth. And guess what? Today you can buy BPI below book value.
Mm-hmm.
Guess what? Ayala Corp, Jollibee, SM Prime, SM Investments. I mean, you can buy them at fire sale prices, pare.
So
So
that's an idea.
it's compelling if you have a long term horizon. If you're a short term trader, it's difficult. I can't give you any advice. That's difficult. But yeah, buy selectively on tips. And when we talk about best of breed, of course, you have the usual management strength. You have the usual long-term profitability,
And these
industry. But I
companies,
think there's yes.
we know these companies are very evident. I mean, you don't have to be so smart to be able to analyze these companies. They're highly profitable. They've been running. I mean, basically we spend money on them on a regular basis. I think that's the best indication as a consumer, no? Saan ba ako naglalabas
Yeah.
ng pera? I mean, most of these companies get a get a share of our wallet, no, all this time. I have a personal question for you, Jun, no? As a, you know, I just want to tell people fund managers are human too, no? So, but the question is, do you still get scared? Do you still get scared about these things? How do you keep your
Um,
composure? How do you become rational? Being rational is easier said than done, but how do you do that? Or how do fund managers do that?
First of all, recognize the fact that you're scared. I mean, if you're in denial, it's going to build up and then it's eventually going to explode, and it's probably not going to be very good for your health. More importantly, ask yourself why you're scared. Why exactly are you scared? What's making you scared? And once you find out, then it's not so scary anymore, actually, if you really think about it. So in this particular case, I mentioned best of breed. Diba? And in this particular case, what helps me keep my sanity is the understanding that valuations are very cheap already in the market. And the valuations you can buy very good companies, best of breed companies at very cheap levels. When the sentiment eases, when daily infection rates have peaked, they stabilize, and then manufacturing indices stabilize also and start rebounding. Fiscal easing is being implemented, or if a vaccine is in place, then sentiment will improve. And this is what has happened in every single crisis. Of course, it's in different forms, diba? But when this happens, sentiment improves. And guess what happens when sentiment improves? The first thing, people start looking at the fundamentals again. Then the fundamentals, oh my God, we're trading at 8 times P or 9 times P. This is even lower than the global financial crisis levels at some point when this market corrected. But more importantly, you have to be we take we make extra we take we put in the effort to understand what when we say best of breed blue chips or high quality companies, what exactly do you mean? Of course, management quality is very important, growth and in a good industry. But I think if we can actually simplify it into 3 factors. First is companies with very strong balance sheets. Under periods of crisis, balance sheets are very important. We spoke with Ayala Corp earlier today as part of our due diligence efforts, and if our estimates are correct, we probably have close to 50 billion pesos in dry powder, about 47 billion pesos in dry powder from credit lines, and they have about 20 billion in cash, I think, in their coffer. So companies with very strong balance sheets. Second is the ability to bounce back strong or even stronger when all of these things come to pass, and they will at some point.
And we've seen them do that.
Yes.
We've
Yes.
actually seen them do that over time.
Mm-hmm.
And your last
And,
one?
uh, and the last one is we try and we like companies that this is more ESG or governance or ESG related. We think ESG is a very strong is a very important factor in considering investments.
What is
And
ESG?
ESG pertains to environmental, social, and governance policies and actions of the company. So we put a premium on companies that have very good governance practices, are highly transparent, and protect the rights of minority investors, those who do not destroy the environment and actually help and work with the environment. And from a social aspect, especially during these times, we like companies that do not that companies that do not sacrifice lives for earnings or the economy. I mean, people are very important. We monitor the treatment of their sick, which companies treat their sick and displaced employees well. Do they pay in full during these trying times? These are the times the employees need them the most.
Okay.
These big companies. So we commend those companies who do that, and we would distance ourselves from companies who do otherwise. I would think.
Do you have a question? Why is that a strong investment consideration? I mean, they're great. They're very. I want companies to be like that. But will that affect the prices in the future, the bottom lines? Why would you put that as consideration at this point?
First, absolutely, Randall. That's because, well, first of all, ESG is probably one of the fastest growing themes or one of the biggest themes in the global investments landscape. Uh, uh, these are principles or this is a movement that is gaining a lot of traction globally, and the assets under management that use this as a factor for making investment decisions is growing or has been growing quite considerably even before after all of uh, this market downturn happened. But and I think that's because ESG is actually indicative of risk in the company. If you have poor governance practices and you do not protect the rights of your minority shareholders, eventually that will find itself in the price.
Mm.
If you have poor practices with regard to the environment and in terms of treating your workers, your employees, and customers and partners, that will find itself that will emerge in terms of poor share prices or in fund managers will attach a higher risk premium for you if you have those poor practices. So this is a very very important aspect, and yeah, that's the third leg of finding these best of breed companies. It's really finding companies that treat their under these circumstances treat their sick or displaced employees well.
Wow. Well, this is good. I hope that everyone's going to be hearing that fund managers, big fund managers like ATRAM are considering ESG in a way. Just to lay my eyes, it's pretty much ethical investing. So, and it's good, and it's going to affect share price and all these things. June, I'm going to share a slide of the PE ratio. You mentioned PE ratio.
Sure.
Just a quick while I'm setting up. Can you explain a little bit for layman people like me what PE
Sure.
ratio is all about?
Sure. The price earnings ratio is the price uh, uh, investors pay for every peso or dollar of earnings they make. So the general rule here is the higher the PE ratio, the more expensive a stock is. The lower the PE ratio, the cheaper the stock is. And you compare, we typically compare the PE ratio relative to either historical levels or relative to other markets. And I think the chart Randall is about to show you is showing that the PE ratio of the market has dropped significantly, meaning it's cheapened or become much less expensive to levels at which the market was at during the worst financial crisis ever, which was in 2008 or 2009.
And we're showing the chart right now. price to earning ratio has been, and that's why people say we're expensive, no? Pag mataas yung PE ratio, and that's the general sentiment. But whenever there's market corrections or crisis, as you call it, PE ratio is one of the first ones to drop because of the price now. So we're now showing you from '05 to 2020. I would like to acknowledge Soldivo Funds for this slide and ATRAM. They're the ones who made this. I did not do this. That's where the logo is there. Soldivo is managed by ATRAM for transparency reason. And that's why I'm investing. Jun, can you just go through this particular slide that you show, that I'm showing right now?
Sure, Randall. Let me just. So the PE ratio is the orange line. So this is the PE. First of all, the PE ratio is computed by dividing the price of the stock by its earnings per share. So it's the price you pay for every earnings generated by the company, or in this case, the market. So this shows that at its peak, the Philippine market essentially was trading above 20 times earnings. So it's in times or X. So chart shows the peak, I believe, was 20. The peak was about 21 times price earnings ratio. This was last achieved back in sometime March 2018 or March 2013.
Okay, when we pick
It has since free fallen to, it has since dropped, plunged, nosedive to closer to 10 times. I think it's at about 10 times already now.
Okay.
And from 21 times back in 2013. So it's lost more than half of its value already. And that's why I mentioned earlier, now, if you have a long-term investment horizon, investors now have the ability, the privilege of buying good Philippine companies, strong Philippine companies, well-managed Philippine companies at fire sale prices, if you can have a long-term investment horizon.
That's where we are. So we're closer to 2008 numbers or early '09 numbers. So June, it's like going back in time.
Yes.
Okay, so again,
taking a trip down memory lane.
June says, do not be the hero. Do not put all your money there. Still manage your liquidity and so forth. But again, we're seeing numbers here we've not seen. And the general sentiment, ayoko mag-invest kasi ang taas ng ang mahal na ngayon. No? So now that alibi has been removed, and these are the numbers that you're gonna show. The next slide I wanna show, okay, here. Sorry. Okay, this is how the market cap to GDP. This down to the down levels. Jun, can you explain this a little bit?
Yes, the PE ratio earlier is a very good indicator of where valuations are, if they are high or expensive or low or cheap or inexpensive. During big swings in the market, however, there are deficiencies in the simple price earnings ratio because there are distortions that are not taken out. When markets move when there are big dislocations, price dislocations in the market, we revert or we go back to what is popularly known in investment circles as the Buffett ratio or the Warren Buffett ratio. And this is simply the market cap of companies in the index or the PSEI divided by the GDP. So this essentially takes into account valuations against the size of the Philippine economy. So, and why is that important? Well, first of all, this actually confirms that the market has breached 60% market cap to GDP, and 60% market cap to GDP level is very significant because the last time we breached 60% to market cap for the PSEI was during the worst financial crisis in financial market history. And so okay, we're at crisis levels, big deal. what's all the fuss about? Well, if you go to the next slide, I think because this is okay if you think the economy has actually regressed, di ba? If the economy has regressed or has is broken and it's free falling and there are no improvements and it's deteriorated remarkably, then that's fine. But the reality is maybe, yeah, I think Randall, you have a chart showing 2009 when we were at these levels, or 2008 versus today.
It is
So
one.
these yes.
So we talk
This,
about the similarities, but there's also something that's different. 2009, 2008 crisis and 2020 crisis, not exactly the same. So June, we can say we're in a better position today. I mean, does that mean also that's going to be we're poised to recover better during 20, and we did recover in 2909. So are you saying that from an economic perspective, we're poised to recover not necessarily quicker but maybe better? Is that a safe assumption?
yes, I think the Philippines has uh, there have been meaningful improvements in the Philippine economy that support a scenario wherein the market bounces, the market and the economy after. I mean, let's be honest. We're probably going to have a recession in the first half of 2020.
Mm-hmm.
Uh, that's possible,
Or
and you
demand
right
growth. I mean,
look forward.
yeah.
The economy, our base case is that the economy will rebound in the second half. Um, but if you look at the improvements, because of the improvements of the economy, significant improvements in the economy today versus 2009, and I'm talking about the S&P credit rating, which is very
Big
important,
change, no? From BB
of the
minus to BB
Philippines,
plus. Yeah.
was double B minus in 2009, and it has considerably been upgraded to triple B plus, and triple B plus, mind you, is just a notch below S&P A credit rating
Mm-hmm.
already, and
There was
that's quite significant.
June, there was
Uh,
about that we're about to hit that S&P level. Is that still at the table right now, or di muna?
I wouldn't uh, put any hopes there in the meantime, given that I think the focus of the government will be containing
Yeah.
the pandemic and then eventually restarting the economy. I think that is the more pressing matter at this point.
Right.
But I mean, yeah, the S&P will look at very important factors like the creditworthiness of the economy, and uh, we don't think there's a long-term deterioration is the point. You will see the economy likely grinding to a halt in 2Q in particular. But we anticipate a rebound sometime second half this year. Uh, Back to the improvements, Randall. I mean, GDP per capita has increased considerably to almost 7,900 as per the table here. Government debt to GDP has improved to 42% from 55%. Unemployment has dropped closer to full employment. And you have the GIR, or the Gross International Reserves of the Philippines, pretty healthy, doubling to about 88 billion US dollars from merely 44 billion US dollars back in '09. So there's a strong argument for a strong bounce once this all comes to pass. Of course, the important thing now is to get everyone, well, to contain the virus and the pandemic, and getting everyone nursed back to full health.
So I guess the difference, what you're saying right now, is you're in a better position today than we were in 2008. In fact, one of those numbers that I like to use is external debt to GDP, which is even lower. We're not susceptible to external borrowing, although at this point in time, everybody's gonna have those things. So these are numbers in a better position, or better, we're poised, and assuming recovery is gonna happen. From an economic perspective, we are in a better position to recover quicker, and this is gonna happen. And once these recoveries will come, you see those stock prices will begin to rise again, and And that's why guys like sila June have been cherry picking, I mean, taking the luxury of buying price at a good time. So this is very helpful numbers, and although a lot of people do not understand this, just to summarize, correct me if I'm wrong, is we're we're positioned better to be able to take advantage of the growth after this is done, after the lockout, and after the economy starts to run or some say that we're about 70% not functioning at this point in time, which I may agree, but we will go back. We will go back to work. We will do recovery, and so forth and so on. It's gonna happen. And I guess another factor that's different between 2020 2008 is the demographics. It's a much younger mobile, younger now. I mean, you have a younger economy that's more vibrant today than in 2008. Is that a factor also, June?
Absolutely. The demographic is the reason there were a lot of foreign investments or before.
That did not change. That did not change. In fact, it's not even affecting the younger people. The virus doesn't. I mean, the general rule doesn't affect younger people. So the demographics is still there. So it's a factor that we need to consider whenever we make these investments. June, you've been very very helpful. This is very good, and just not to pull your leg. No, I mean, I do I do invest myself. And but I do a little bit investing on my own. I put more in funds like ATRAM and Soldivo and the other funds because of guys like you who, although I know you're human, but sometimes I feel like you're robots. But you're very rational the way you do these things. I get emotional with these things. I get spooked also, and that's why I trust people like you. And I hope that people will understand this more and more for these things. Now, June, I wanna, what would be your general tips for people who are investing? One, just to put a fraction, there's those who bought investment funds during when it was 8,000, 7,000, 6,000. What would you be advised to them? And for those of them who are parang regular investors, people like me, who regardless of the market, I invest, naka-cost averaging and everything. And then the third one, number one, those who invested before. Second, those who are constantly investing. And lastly, those who have not invested, but they feel that they're ready. Financially speaking, may emergency funds na kayo, may insurance na kayo, and those things, they are ready to invest. What would be your general advice to them?
Well, the general advice I would think would be to pick your spots. Like I said, don't be a hero. There will probably, things could get worse before they get any better. But the reality is also, number one, our outlook is for the market, the economy first, and then the companies in the economy, and then the market will bounce back and normalize at some point within the year, second half in particular. You will still see some negative news out there, and the markets will probably still react to the negative news. But the reality is that the long-term outlook is not broken. The economy remains strong, although will be grinding to a proverbial halt in the short term. But the long-term story is still very positive. Our base case is that while there's a high likelihood of a recession in the first half, GDP and earnings growth will recover and rebound in the second half of the year, whether it's the third quarter or the fourth quarter, on the back of the recovery in domestic demand, continuation of accommodative monetary policy, a resumption of the massive infrastructure spending program of the government, and there are potentially significant and meaningful structural improvements that could be on the way. And we're talking about the potential for large-scale corporate income tax cuts. There's a law, I think, in Congress that may, if and when it happens, result to a 500 basis point cut in the corporate income tax rate, and that will be embraced by investors in the long term. There is also the recent lifting of foreign ownership limits in in most industries, and that will be embraced as well. And of course, the implementation of the real estate investment trust law, which will revolutionize the local real estate property market, and that should be um, good as well. Valuations are very compelling at this point. Although, like I said, we may not have seen the bottom yet, but it could happen within the next 4 to 8 weeks. Um, when we get back to the levels at which this market was um, year, early this year or late last year, you're already talking about a 46% rebound. We're not saying it's going to happen soon, but I think that's a likely scenario once the sentiment improves and investors start looking at fundamentals again, because the long-term fundamentals are remain very strong for the Philippines. You'll get a bump in terms of near-term news flow, and the strategy remains. Our strategy is to position for essentially 2021, because now we have the opportunity to buy very good companies, very good stocks, high quality stocks at suddenly very inexpensive levels. The upside on companies, on very good companies, are quite significant. We're looking at about 80% upside for Jollibee and SM Prime at these levels. Ayala Corp, Ayala Land, BDO, BPI, in PLDT, SM offer significant upside at these levels. In the second liners or the mid cap, small mid cap space, Wilcon presents meaningful upside at these levels. But yeah, you just have to pick your spots, I guess.
Right. So June, so basically with all of these things, you're still actively managing the funds right now. So that's ultimately gonna reflect in their NAVs, their NAVs. Ultimately, maybe not this year, but ultimately that's gonna show. So is it safe to say for those not to redeem their funds at this point in time? And then you just have to wait. I mean, of course, the funds are still being actively managed. One of the, I guess, advantage of a managed fund is these things happen. You still invest, you still put this money. So is it safe for me to say, I mean, I'm holding on to whatever investment, even if I bought some at 8,000. Is that a wise thing to say? Is it prudent for me to tell people not to unload, not to redeem your funds?
Absolutely. Of course, everyone will have an opinion. My opinion is that this is the best time to selectively invest in funds or stocks.
Do not redeem, and if you can, add on. I mean, again, depending on your level of financial preparedness. No, this is
not just any fund, Randall. I mean, of course, you have to understand the strategy of the fund you'll be investing in, and I would invest in funds like ATRAM that are really positioning in best of breed quality stocks that adhere to the criteria I mentioned earlier.
And of course, Soldivo, no? Siyempre.
Yes, Soldivo, of course.
Soldivo is being managed by ATRAM for these things. And wow, these are good opportunities for us. We're not discounting that, it can get worse before it gets better. We've seen that. We've experienced that, June and I. Although I'm a little bit older than June by maybe 2 months. But if you can add on a little bit. June, were you already in the financial services during the coup d'etat issue? Or are you still in school at that time?
Not yet.
I was in the bank already. I remember the.
Okay.
And we've seen that. We've seen even minor ones. Remember the BW and all these things.
Right.
I think what the general sentiment is that we're more the economy, and even us Filipinos, we're more resilient than we give ourselves credit for. And I'm really looking forward to recovery. And I'm not saying that I'm a foolish optimist, but we've seen these things happen. I had a session with Rex Mendoza. Our friend Rex is much older.
Of course.
Much older.
Hi, Rex.
So when these things happen, we've seen that. We've experienced that. June has experienced that despite the youthful look. He's experienced major crashes. And although although this is different, there's things are again similar, and I hope that this session is going to be helpful to number one to for us to contain our fears and not to lose hope with that. So June, thank you very much. Any parting words for our viewers here?
Stay healthy, everyone. Because before you can take care of anyone else, you have to take care of yourself.
Of course. Ano mo yung pera mo pag wala may
yeah, just try and be as objective and rational as possible, and keep healthy.
Yeah. And ATRAM has a very active social media account. They have Facebook. They even have Instagram. You do follow ATRAM. They do a lot of updates there. I know you have a series of webinars coming in. So they continue, and I love being an investor of ATRAM because they continue to give us information, and we're gonna see more of that. So June, I'm for ATRAM, you guys please do follow their Facebook page and so forth. With that, thank you very much, June. Thank you so much
Thanks, Randall.
for
Thanks for having me
and teaching us at the same time. God bless you.
God bless you.